Hello, Maverick traders. Welcome out to your market roundup for May 4th, also known as Rob's birthday. So happy birthday, Rob. As always, just jumping into the markets, we're going to look at what's happening, what's moving the markets, and where we think we go from here. So for the S&P, the Dow, and the NASDAQ, Russell especially has underperformed. These other markets have held up relatively well, but each of them currently in a pullback pattern. The rallies that we had last week have basically dissipated. Oil slightly higher, gold slightly higher as well, each up about 1%. Those two roads have diverged where gold has held up really well, been making new highs, but oil has been getting hammered. Oil would have a tendency to be a little bit more economically sensitive, right? Oil has to be used and consumed, otherwise it will spoil. If the expectation is that the economy is going to go into a big downturn, oil would be more negatively impacted, whereas gold is kind of an anti-currency. It certainly does well when bank risk rises, and we're seeing that. So on the daily news, we had the Fed funds increase of 25 basis points yesterday, a little bit of a hangover from that. Markets continue to struggle. And then now we're seeing the regional bank risk starting to spread. A lot of the West Coast regional banks are getting hammered, in some cases down 50% on the day. And that's sort of spreading, that contagion. That's the risk. That's what's derailing the markets, no doubt, the last couple of days. And the more those risks rise, the worse it becomes for markets. Now, I had been on record a few weeks ago saying, look, if it's not spreading, it's over, right? Well, it's spreading now. So over the last couple of days, should you be aware of that and understand that when you wake up and regional banks are down 30, 40, 50%, that is not a good thing for markets as a whole. Advanced decline line, about 60% of stocks going down, but not a massive, it wasn't like mass deterioration today. Worse yesterday, actually, on the Fed meeting. And then the 50 period MA is trending the wrong way, tipped a little bit from last week to this week, where now 63% are below. Last week it was about 60, so it's trending a little in the wrong direction. Let's take a closer look here at the market. So we still have the call that I made for a cup and handle was perfect until it wasn't. Isn't that the case? So we had the retest of resistance up here, and when we pulled back initially, I got bullish at 40.72 and said, this looks like a great buying opportunity. And over the next 2-3 days, we went 2.5% higher, and it looked perfect, and it felt perfect. Well, you better have taken profits on something, because it has now given all of that back, and we're right back where we started. So this is kind of a make or break area for, first of all, this price pattern, this chart setup. Now, a 2.5% move higher is something that you can capitalize on, but you wouldn't expect it to give it away so quickly, right? Even if we pull back a little bit, you'd expect a bounce, that maybe that breakout was going to come. Usually you establish resistance, you retest, and then the third time's the charm and you go up and through. This was a really missed opportunity by the markets to make that move higher. So if the S&P doesn't hold here, it breaks this price pattern, but it breaks the 50 MA. It breaks a lot of things. So it seems like a very important level. If you just look back here, look at old resistance, new support, and so on. And it just, I think we're at pivotal spots right here. If we break, one would have to get more bearish. Now, if we break, be careful about, you don't have to necessarily get short on the day we break. Now that might work out, right? We could break here and just start to slide. And if you got short, you're very happy. But I don't think you have to do all of your shorting right there. In fact, I wouldn't. What often happens is, instead of this big follow through, you sort of break and then you bounce a little and establish a lower high here, and then you roll over some more and so on. So there's better opportunity to short. Even though this really signals that we've got a problem on our hands, this might be the better entry point. So you can spread out some of that bearish entry point across the board. I don't think it all has to be done at once, a sort of a big shift and you flip a complete 180 and everything's bear. It doesn't need to be that dramatic. Usually in the markets, you can kind of work your way in to things, and I would think the break and then the establishment of a lower high and start to pivot down. That lower high is the better risk reward probability kind of setup in my estimation. So I don't know if we're going to break. I don't know if we're going to hold, but certainly the markets after that initial pop to the upside, you'd think that, okay, this could really be it. We could get that big blow off top we've been waiting for, and it just didn't materialize. NASDAQ holding up better still, but again, just really kind of a false move. We pierced above that, and now we're sinking back in, and this makes me nervous. There's an old saying, from false moves come fast moves. Well, here's the false move. Now we might get the fast move. And so should you look at doing some shorting as the market's breaking down and so on? Maybe, hopefully, you've already done a little bit and already seen kind of what's been transpiring. I mentioned last week when I did the market roundup that I was looking for, on the bearish side, for a couple of things that looked like they were going to bounce for a couple of days and then to get short. The targets of the world and I think we highlighted Prudential, PRU, and so forth. And sure enough, they bounced for a couple of days. That was an excellent short, and they've fallen to pieces. So there will be opportunities, but a bit more nervous than I've been about the markets really right here. Now, we'll see. Banking sector is certainly in the eye of the storm. Other things that are more economically sensitive have been getting hit. Consumer stocks, energy stocks, none of that can catch a bid. The only things really holding up well are large cap tech. That, for the most part, in defensive areas like, the Procter and Gambles of the world, they've been making new 52-week highs. Is very strong and defensive, but that doesn't, defensives and large cap tech are kind of hideout spots. So we need that market breadth to spread out. We need other stocks to participate. We need the rally to widen out, and that hasn't happened. Can we say we're as bullish? I mean, we're still in an uptrend, but hanging on by a thread. We might see a piercing of the 50-day. We might have seen some false moves above those levels, and the market just didn't have it. Perhaps that's the case. Let's look at a few different names that still look like they could be potential buys or sells. On the bullish side, EWJ. Here we've got a highlight of a price pattern that's holding up better. Now notice this is the Japanese ETF. Notice above the 20, above the 50. A little bit better than even the NASDAQ as an example. And still the cup and handle type of dynamic in play. So EWJ looks like we're going to break out to the upside and make a move. Looking at Oscar Health. This one just popped up on a scan. Now, I don't know if I'll trade this or not. I really am not inclined to trade really low price stocks. Maybe, perhaps, but again, relative strength, nice price pattern, kind of an ascending triangle. Looks like we may get a burst to the upside. And then last but not least, Uber. And this one looks like a buy the dip candidate. So we've now come into the old resistance. Here's where it was established. This should be the retest. You get a little pullback here, and it's that dip that I'm more interested in buying. So give me a setup down here that I can sink my teeth into. I'll probably do that and try to play the next bounce in Uber. On the bearish side, Caterpillar, descending triangle. These price patterns are fantastic bearish entry points usually. Think of it as a bouncing ball. You drop the ball on the table. The first bounce is a little larger, then the next one's a little smaller, and next one's a little smaller until you fall off the table, right? That's the descending triangle, this bouncing ball getting lower and lower, more compressed, and looks like a downside breakout looms. MetLife, here we've got a big drop. I'd expect a small bounce. And again, for this one, I'd like to see a little rally up and short that next lower swing high. And then last but not least, Tesla. Now, we highlighted this one back here pre-earnings, and I really liked Tesla as a bearish trade back here going into the earnings. Let's assume you didn't trade that and you're just looking for a new opportunity. I think we're kind of making a little minor ABC type of dynamic. I could see a couple more days bounce, maybe right up and meet that 20 period moving average. So I'm looking at around 170-ish as a possible short. And again, I want to see it bounce for a day or two, but then look to short it for that next wave. I think we're in a little bit of a pause, but there's going to be more fury to the downside. I think this is something where funds are distributing shares. This is one that could see, I mean, throw out a crazy number and it might get there in the short term. We could see the 120s. We could see the 100 teens, that type of number, I think is very much in play over the next couple of months. Markets, that cup and handle now on shaky ground. It looks so good, zoomed higher by 2.5%. We seem to have fallen back, and now at kind of this critical juncture for the S&P 500. Tomorrow morning we've got payrolls. Apple reported after the bell tonight, and so far it was up. That doesn't mean it'll stay up, doesn't mean it'll be up by tomorrow morning, but initially a tiny pop. I think it was up like $2 per share after hours, which is next to nothing. It's a small bounce so far. Earnings reports. We've got Cigna, Dominion, Johnson Controls, Warner Brothers Discovery. They all report tomorrow morning. Berkshire actually reports over the weekend. They're a rare company that does that. They'll have their annual meeting. You'll hear a lot about that. People descending upon Omaha. I was actually in discussions with a friend to go this year. I own some Berkshire Hathaway shares. I can get in through those doors. I think we're going to do it next year. So Charlie Munger and Warren Buffett need to hold on a little longer. And we're going to try to get down to Omaha and actually attend the meeting next year. So that is it for our market roundup. Everyone have a great rest of your day, and we will see you next time. Goodbye, everyone.